All right. Good morning, my fellow capitalists and profit seekers. I am your growth stock guru, Rick Action Jackson. Thanks for joining us today. I'm going to walk you through my 3 favorite stocks to buy today based on my top quintile strategy discipline. Top quintile strategy is designed to focus on companies that could double your money in less than 4 years. And we only want to buy companies that are beating the earnings estimate that Wall Street has put out there for the company, because historically the best stocks have consistently beat the Wall Street forecast. This is not financial advice. This is education and entertainment only. If you like any of these stock ideas, please discuss them with your financial advisor. Make sure that the risks involved and the asset allocation involved meets your goals and objectives and your risk tolerances. The stock market can be a scary place. You can lose money. No tears if you do. All right, back to our top 3 buys today. We're going to kick off with Eli Lilly, LLY. Let's go to the chart. Here's the 1-year chart on Lilly. Eli Lilly has just been a fantastic stock for my entire career. Let's do the 5-year. You can see 5 years ago it was $250. It's up over $1,100 today. And if we go back even further, I became a fan of this company back in the 90s. And if you bought this stock back in 1990, you paid between $17 and $15, and it's $1,100. Type of stock that changes people's lives. They continue to be one of the best R&D shops for both productivity and efficacy. Their drugs work, and they're very good at coming up with drugs that help millions of people. They reported their earnings this morning. I was happy that I only saw the stock up $30 in the morning. It's up $50 now, but you know what? It's still a bargain. My target on Eli Lilly for December 2028, I'm raising it because they had a blowout quarter. So I'm raising the target from $1,950 to $2,050. And the target for 2020 is $3,000. And knowing the pipeline on Eli Lilly of new drugs as I do, $3,000 is probably very conservative for 2020. Their numbers were unbelievable. They came in with $8.38 a share for the quarter in profits. Wall Street was predicting $6.10. They were predicting 20% growth. They came in with 48% earnings growth. This is a company that within a year or two is going to have $1 trillion market cap. You don't see companies that big grow that fast. Their revenues came in at $23 billion. They were expecting $20 billion. Their revenue growth was over 35%. Wall Street was predicting 17%. Exact quote from the CEO: "There is limitless demand for our weight-reducing drugs." The only negative thing you can say whatsoever about this company is that this was the first quarter their pill version of Wegovy was on the market, and it came in a little bit light of forecast. But all the other weight loss drugs they have weight loss drugs for children. They have weight loss drugs for people with diabetes. They have weight loss drugs for people that are pre-diabetes. They have weight loss drugs for people that are not diabetic. They have weight loss drugs for people that are built up with muscle because they used to do roids or they used to lift weights and now they want to lose weight. They got about 7 different weight loss drugs, and they can't make the drug fast enough. Those sales are booming, and they have 2 other blockbuster drugs in the pipeline, one involving dementia and another one involving the immune system. So when eventually all of America becomes thin, the growth story on this stock is not done. If you don't own Eli Lilly and you want to have a serious stock portfolio, you should buy it today. This company, when I saw the numbers, I thought this stock was going to open up at $1,300. Only up 3 to 5% when their growth was 48% and it was expected to be 20% is a gift. The only reason why I think the stock isn't up more is for whatever silly reason, the average retail investor doesn't want to buy a $1,000 stock. That price means nothing to institutions, but all the institutions already own this stock. The quarter could not have been better, and the reaction was minor. That means there's an opportunity here. Buy Eli Lilly. Again, my target for 4 years out is 3,000, which would be a 250% return, and I think 3,000 is conservative. Next, we have Tempus AI, ticker TEM. Raise your hand if you never heard of this company. I never did as of 3 months ago. The more I study this company, the more I love it. The pullback in this company was part of the SaaS apocalypse, software as a service. When Anthropic came out with their third or fourth version, where you could talk to the program and ask it to design a software program that does X, Y, and Z, and the thing creates a software program within an hour, Wall Street lost its mind and thought, oh my God, every software company in America is going out of business. Microsoft went down 40%. ServiceNow went down 70%. The average software company went down 78%. This company technically is a software as a service company, but it's not really. It's a biotech company. What these guys do is they have genetic tests that you take when you go and see the doctor. And when they process the results are automatically, electronically uploaded into the doctor's computer. It's automatically uploaded into your online record keeping. And they keep a third copy of it that's anonymous on who it belongs to, but they have all the data for drug testing. This company today makes money on the actual tests that humans take on their blood when they get a checkup. Tomorrow, they're going to make royalties on drugs because drug companies are going to get to test their compounds on their data. And when the drug gets approved, they're going to get a cut. And what the future is within 5 to 15 years, you're going to go to the doctor. You're going to get a blood test. They're going to do a DNA test on it. And they're going to create a custom drug for you to fix whatever's wrong in your immune system. Over half the things that kill us, bad viruses, cancer, they all occur because our natural immune system to crush that disease wears down. Children don't get sick much because their immune system's intense. Kids can eat dirt and they don't get sick. Most of them don't. As you're an adult, if your DNA or RNA gets damaged at all or gets worn out and it stops making the amino acids or peptides you need to defeat these things that attack your body, these drugs are going to be able to repair it. This company is going to test those drugs. It's going to profile you to see which one you need. And for the next 5 or 10 years, we're going to take drugs that address millions of people at a time. But down the road, we're going to get customized drugs. And they're going to work really well. And it's going to be an amazing future if you can stay alive that long. So buy TEM. It had a great quarter. Came in with a 4-cent loss. They were expected at a 15-cent loss. My targets on this are $80 in 2 years and $125 in 2. It's a bargain under 50. It beat all the numbers over the last 9 months. The only reason this stock is down is it's technically a software as a service company. But if you recreate their software, you're not going to have the DNA data. You're not going to have the diagnostic knowledge on interpreting that data. This company's not going to get replaced by an Anthropic homemade software system. And Wall Street's starting to realize that and starting to reward it. So under 50 here, I think it's a great buy. They're cash flow positive. The reason they don't make money is they reinvest all their cash into building up their diagnostic and data capabilities. But they will be profitable within a year or two, and they'll be enormously profitable when all 3 ways they make money kick in. Like I said, right now they're only making money one way, but they will be making money 3 ways in the future. Revenues are growing nicely. TEM, buy it under 48. It's at 46 and 69 cents at the moment. The last one is controversial, and this stock has broken my heart many times. It's the Walt Disney Company. This company has the greatest media empire in the world. They own everything. They own Mickey Mouse. They own Donald Duck. They own Snow White. They own all those cartoons that the boomers and myself grew up with. I don't know if the young people today grew up with them, but we all grew up with them. They're timeless classics. They own the theme parks. They own the cruise ships. They own ESPN. They own ABC. They own practically a third of Hollywood. And yet this stock has been a dog for years. The fundamental reason why is that ESPN's revenues have been shrinking every year because the cable empire is melting down and Walt Disney hasn't figured out yet how to make money with ESPN online. They're starting to get there. They're starting to charge a bundle rate where ESPN gets a decent cut. They bought Roku. Roku's going to have packages out pretty soon that are going to include cable and online premium services where you avoid all the annoying ads. And ESPN gets a pretty decent slice on that. ESPN's probably hit a bottom. They're probably going to see their revenues stay flat to growing from here. The content they have is tremendous. Disney just hasn't figured out how to charge for it. The other two reasons why I think the stock hasn't done anything is that Disney lost its way in the movie theaters. They haven't had many blockbusters in a long time. Although Spider-Man's doing great, they split that with Sony. And they got a couple other movies coming out that I don't see how they can miss. One's a Star Wars follow-up. One's another Marvel comic follow-up. One's they also own that Jeffrey Katzenberg's cartoon empire, which is just a money machine. So the cruise lines are now making money. They weren't during COVID. The theme parks are making money. They weren't during COVID. Movies are starting to do better. ESPN is rebounding. This stock is super cheap. This stock used to be such a reliable moneymaker that it would sell at 30 to 40 times earnings. It's currently at 15 times earnings. The market's at 20. Normally always had a multiple higher than the markets. Their earnings aren't bad. They've beat Wall Street expectations 4 quarters in a row. The reason why I think the stock hasn't gone anywhere is that there's been some turmoil at the top for the last 3 or 4 years. When Bob Iger retired, and his CEO handling of Disney was first rate, this stock was a monster stock the first time he was CEO. But he came back and he did turn around the earnings and he did lay off some people to right-size the company. But the Wall Street never really responded to the improvement in profits. Probably because they bought Fox Studios and they paid too much money for it. But now Disney's selling at 2 times revenue. They normally sell at 4 to 6 times revenue. And they're the biggest movie studio in the world between Fox and Disney and Marvel and Star Wars and all of them combined. It looks like Americans have a taste for going back to the movie theaters. And if that's the case, if that's true, I mean, where kids go on dates, you know? I mean, and the movie theater's now charging outrageous price for tickets, $20 to $40. But at that level, they're making money. And at that level, you got a hot date, you'll pay it. Or if it's a great movie, you'll pay it to see it on a big screen. I got a feeling there's a turning point for the company. They've beat the numbers every quarter for the last 3 years. On a valuation basis, it's been a buy, but it's been dead money. They got a new CEO. The CEO's style is totally different. First off, he's not political. And as Michael Jordan said, Republicans buy sneakers too. I think Disney lost a fair number of customers with some of their political stances in the last 5 years. And Bob Iger even played with running for president. And if he'd focused on being a CEO, maybe the stock would be 50% higher today. If the movie, and what he said his plan for the movies were, rather than put out 12 movies a year, he'd rather put out 4 blockbusters, which means you got to be better at picking which movies you make. So far, Disney's had 2 blockbusters this year. They have 2 more. Spider-Man was the highest grossing movie ever. Now, it's because they're charging $20 a ticket, not 5, but still, it did $900 million its first weekend. It's an enormous amount of money. And the way the math works on that is the movie theater usually gets half the money and Disney gets half the money. So they spent $300 million on a movie that made $450 million the first weekend. It's pretty good. And they have a library of entertainment that is worth billions. Billions. They own Fox, 20th Century Fox. They own Disney. They own Mary Tyler Moore. I could go on forever. Jeffrey Katzenberg stuff, Star Wars, Marvel Comics. And nobody owns this. Nobody owns this. All the hedge funds have sold this stock. It had a nice trading day here. Let's go to the chart. It broke up above its 90-day moving average, which is very good. If it can stay here above the 90-day moving average while the 90-day moving average catches up with the 200-day at 104 and stays above the 90 the whole way and then breaks through the 200-day, the day this stock breaks the 200-day, it could have a massive run. And what do I mean by massive? I mean, this thing could go up $30 to $50 in 3 months because nobody owns it. If the stock starts showing some momentum upward, everybody's going to have to buy it. And I think that's going to happen. I think this new CEO has avoided every opportunity he's had to get political. And I think that's the right way to run a public company. Sell to the Republicans and the Democrats and the people that don't give a damn. And so far, that's what this guy's doing. He produced a great quarter. They beat the numbers. I think it's $160 stock in 2 years and $250 in 4 years. And at $250, Disney's only selling at 4 times revenue. This stock in the past, when they've been on a roll, it has sold at 6 to 8 times revenue. And it's only selling at 25 times profits. It has sold at 30 to 40 times profits in the past because everybody said, oh, Disney's business model is timeless. Every 10 years, they recycle all their movies for the youngsters. It doesn't cost them anything to do that. They don't even have to pay the people that acted in the old movies. So you would think that with the right management and the right streaming vehicle, and I think Roku is going to solve a lot of their problems because Roku is offering a very competitive platform. It's gaining market share. So if you're a different platform like Netflix, you're going to have to buy Disney stuff to be competitive. And I think finally the dying cable box is going to be off their back. So it's become such a small amount of their revenue. 15 years ago, their cable revenues were 40% of the company. They're down to 15. So it's a lot easier now to grow faster than cable shrinking. And I think it's time to buy this stock. Now, I've bought this stock twice before in the last 2 years. Once I made a lot of money when it spiked up during COVID. All the media companies went up during COVID. That was it. That was the run it had here back in 2021, 22. I sold half my position at 150 and the other half up around 210. But I once before tried to buy it here in 24, and it went up to about 118, ran out of gas, didn't sell any, wound up selling all of it back down in the 90s. It's been hanging out here in the 90s for a long time. When this thing breaks 120, it's going to run to 160 to 200 very quickly. And I think that happens in the next 12 months. So buy Disney. Don't chase it. It's at 101 today. No reason to pay more than 102. I like it at 102. I like it a lot at 98. I love it in the low 90s. Pays a good dividend. Pristine balance sheet. If America goes into a horrible recession, this is a great place to hide. And TV viewership goes up in bad economies. So historically, the entertainment companies have done well. The golden time for Hollywood was the Depression. Because for a nickel, you go into a movie theater, watch a double feature and a couple of cartoons and forget all your troubles. Disney's time, I think, has come. I really like this chart action where it popped back above the 90-day. And if it can stay up here, it'll probably break out within 3 to 5 months, and then it'll do some real open field running. All right, that's all we got for today, folks. Disney, Tempus AI, and Lilly. Thanks for joining us. And may all your trades be profitable.